MSA Capital Managing Partner Ben Harburg joins us now from Beijing. Always good to have you, Ben, to check in on a myriad of issues, and there always are with China. Let's just start off with sort of, I've got you saying that there's a lot of capital still sitting on the fence waiting for policy actions behind what has certainly been some positive rhetoric when it comes to regulation of the tech industry. But what would you be looking for in terms of actual policy actions that's going to get that capital off the fence, so to speak?
We've got the National People's Congress coming up in March. That will be one of the key milestones where they'll set out their growth targets for the year and answer some of the how questions rather than just the what. And so obviously what we're looking for are sustained support of the private sector, some of the rollbacks in these regulatory measures, an opening of the public markets, both domestically and that those channels that purportedly will be open starting in March for companies in China to go public overseas, and just a overall sustained support of entrepreneurship and the larger technology companies who were hit so badly over the last couple of years.
And with that, you expect as well that we're going to see a lot of money in infrastructure coming, or for infrastructure?
Chinese government has no choice but to stimulate growth. All of those regional governments around the market that were previously tasked with maintaining COVID zero over the last 3 years are being told grow at all costs. A lot of that will come by way of infrastructure spending. And having just come out of a Track 2 event just a few days ago, the word on the street is that it should be a kind of 7% growth year around China as a result of all that stimulus.
I mean, you've actually got an IPO coming from one of your portfolio companies right here. Is that a sign of things to come? I can't, there was a period where it was every day. There was a Chinese company coming public here at the NYSE. I can't remember the last time we even saw one.
Well, there haven't been a lot of American companies going public there either, but
that's a good
certainly
point. That's
there
a good
was,
point.
Certainly since the DD IPO, that fell off a cliff. That channel now, with the public accounting oversight folks from the SEC feeling more comfortable with Chinese audits, appears to be reopened. That threat of delistings, most importantly, off the table. And now I think those channels will be reopened. The CSRC publishing guidelines that will go into effect March 31st around Chinese companies going public in the U.S.
Ben, what about the regulatory crackdown, which has been such a headwind for these stocks? And it's so hard to read the official commentary and signals on this. Are they uncracking right now?
The tone is certainly softened. Of course, out of the Central Party Work Conference, we heard no mention of the regulatory interventions. We heard no mention of common prosperity and some of the other buzzwords that have scared away Western investors. Again, I think the Chinese recognize, and we really saw a clear policy shift from the end of December onward that was both domestic policy, healthcare policy, foreign policy, that from that point onward, growth had to be the focal point of everything that's done in the market. And anything that scares away Western investors, like regulatory interventions, has to be softened and rolled back.
Hey, Ben, Morgan Stanley today has a chart looking at what they're calling the worry-free Chinese consumer. One that expresses growing optimism about the macro and their own financial situation. They say real private consumption could grow by 9% plus. I wonder if you think that's likely given what we know about at least youth unemployment in China.
It's tough to find a job in China, but certainly there was a huge amount of capital sitting on the sidelines in terms of discretionary spending over the last 2-3 quarters in China, where SMEs didn't know where their next paycheck would come from. People were afraid to go to malls because they were worried of getting caught in some kind of a quarantine or outbreak. And so that is returning. We saw kind of record high levels during the Chinese New Year period of tourism relative to kind of 2019, 2018 figures. So I do think there's going to be a lot of discretionary spending coming back into the market. That's what they're projecting. And all systems seems to be go from our kind of a qualitative viewpoint as we walk the streets of Beijing.
Ben, you mentioned obviously a number of potential positives for Chinese companies during just the course of the last few minutes. But I wonder, with a backdrop of so much risk, for example, if the Chinese were to begin arming the Russians, perhaps it's unlikely, but if that were to happen, you could imagine, again, a series of things the U.S. would do that would be particularly bad for the world economy, not to mention China. How do you as a fiduciary manage that potential risk, given the heightened tensions between our two countries?
certainly the United States has put in place now a regulatory regime that enables it to take significant retributive action against the Chinese were they to get involved in Taiwan or take actions that would arm the Russians. For us, we believe it to be a very low likelihood. The Chinese to date have towed the line on sanctions. And again, as I mentioned, it's grow at all costs right now. Anything that would retard that growth could lead to further outbreaks in the streets, as we saw that kind of brought the end of zero COVID in Q4. So I think it's highly unlikely the Chinese risk economic sanctions at this point because the Americans have put in place such an ironclad framework to prevent against that. So we're betting that that won't happen.